It's Saturday, January 31st, 2026. Gold just did something that usually doesn't happen quietly. It hit a record, then it dropped hard in hours. Here's the question. Was that a normal profit take? Or was it a liquidity event in disguise? By the end, you'll know the clean tell. You'll know why the reversal matters more than the record. And you'll have 3 signals to track this week. Start with the timeline. Late this week, gold pushed to a fresh all-time high. Then the move flipped. Prices fell sharply into the close. Here's the receipt. Reuters described gold hitting a record level, then posting one of its biggest one-day drops in years. That combination is the story. When gold grinds higher, that's common. When gold gaps up and then gets sold aggressively, that's often about funding, not beliefs. Because gold is a source of cash. It's liquid. It trades deep. It can be sold fast. So in stress, gold becomes an ATM. Not because people hate gold. Because they need dollars now. That's the core mechanism. Step 1 is a shock. The shock can be rates. It can be a dollar snapback. It can be risk headlines that raise margin demands. Step 2 is position pressure. Funds that were long gold for protection get hit elsewhere in the book. They sell what they can sell. Step 3 is transmission. Gold selling tightens conditions at the margin. It can pull other risk hedges lower. It can also signal forced deleveraging. Now connected to the tape around it. This week had 3 cross currents. Fed path chatter after the rate decision, dollar volatility after public rhetoric, and equity hesitation around policy headlines. Gold sits on top of those. If real yields rise, gold fights gravity. If the dollar bounces, gold loses support. If margin calls hit, gold gets sold anyway. So, the record does not matter by itself. The reversal is the information. Here's how that works in plain English. Gold has 2 big drivers in the short run, real rates and funding stress. Real rates are what you earn after inflation. When real yields rise, holding gold costs more. Gold has no coupon, so higher real yields are a headwind. Funding stress is different. In funding stress, gold can go up first, then down fast. Up on fear, down when people need cash. That's why you can see a whipsaw day. The market buys protection. Then the market sells it to meet demands. Now look at the cross-asset footprint. If this was mainly real rates, you usually see a clean pattern. Real yields up, dollar up, gold down. Equities often wobble too. If this was mainly liquidity, you can get a stranger pattern. Gold down, even if the dollar is flat. Gold down, even if rates barely move. That's forced selling. So, what happened this time? The press described a violent reversal, and the broader tape was already choppy. That is consistent with a liquidity-first story. But we don't guess, we check receipts. Receipt moment number 2 is simple. Pull up the 10-year TIPS real yield on Fred. Then pull up the broad dollar index, also on Fred. If the reversal day lines up with a sharp real yield jump, that's a rate story. If real yields are steady, but gold still dumped, that's a funding story. This matters because it changes what could break next. If it's real yields, the stress spreads through discount rates. Rates hit equity valuations. Rates tighten credit. Rates squeeze housing and autos over time. If it's liquidity, the stress spreads through leverage. You see it in vol, you see it in credit spreads, you see it in weird basis moves, and you see it in how safe assets behave. The safe asset that falls is the one that funds the system. So the correct way to read this is not, gold is bearish now. It's, what forced this unwind, and is it done? There are 3 common triggers for a gold reversal like this. 1 is a surprise in real yields. 2 is a sudden dollar rebound. 3 is margin-driven selling linked to equities or rates. You can usually spot which one dominates within days. The next moves in rates and FX tell you. Now the real economy angle. Gold is not just a chart. It's a signal for inflation psychology. It's also a signal for risk appetite. When gold rips, people feel uncertain. When gold crashes after a record, people feel whiplash. That can feed into sentiment and spending. It also hits sectors. Miners can gap down. Jewelry demand can shift. And central banks and reserve managers get watched harder, even if they did nothing this week. So, what do we watch next? Not opinions, signals. I'm going to give you 3, and only 3 with where to look and typical timing. Then we'll explain what each outcome implies. Then we finish the mechanism chain, because the why matters. A record high day can be pure positioning. It can be a short squeeze. It can be a momentum trade. But a sharp reversal day tends to require a push. Either funding got tighter, or real yields moved against gold, or the dollar flipped. That push shows up in other markets. So, your job is to line up the footprints. If the dollar rose sharply that day, you've got an FX-driven move. That often happens when U.S. yields rise or when policy headlines shift expectations. If real yields rose sharply that day, you've got a rate-driven move. That often happens when inflation risk rises or when the market thinks cuts are farther away. If neither move much, then you assume liquidity stress. Then you look for the stress migration signs like credit spread widening or vol spikes. And that is what makes this story viral. It's not about gold fans. It's about the hidden plumbing of risk. In other words, the chart is a symptom. The system is the mechanism. Now, let's turn that into a clean read. If you only remember one thing, remember this. The biggest clue is not the high. It's the speed of the unwind. Speed usually means constraints. Constraints are either pricing constraints or balance sheet constraints. Pricing constraints show up as rates and FX. Balance sheet constraints show up as forced selling. So let's map both paths. Path 1 is the real yield path. Real yields rise, gold falls. That's mechanical. Why would real yields rise suddenly? There are two common reasons. Inflation fears rise faster than nominal yields fall, or the market pushes the first cut farther out. Either way, real yields feel tighter, and gold loses support. In that path, you often see something else. Rate-sensitive equities get hit. Long-duration growth names wobble. Credit gets a little wider. It's not a crash story, it's a discount rate story. Path 2 is the dollar path. The dollar bounces. Gold falls. That's also mechanical. A stronger dollar makes gold more expensive for buyers using other currencies. It also shifts the store of value comparison, at least for traders. The dollar can jump for simple reasons, a hawkish repricing in the front end, or a credibility shift in policy expectations, or just short covering after a slide. In that path, you may see commodities soften broadly. Oil can hold up if it has its own driver, but metals can cool fast. Path 3 is the liquidity path. That's the one that scares people, because it's not about a view, it's about a constraint. Liquidity path starts with a hit somewhere else. Equities gap down, rates sell off into an auction. A big macro headline shifts positioning, then margin requirements rise, volatility rises, brokers ask for cash, funds sell what they can sell. Gold gets sold because it trades, not because it failed. In that path, you often see odd pairings. Gold down, while fear headlines are still hot. Treasury yields not moving much, even as risk assets wobble, credit spreads widening with a lag. The key is the lag. Liquidity stress often moves in waves. First is the sell. Second is the scramble for collateral. Third is the stabilizing bid. So, how do you tell which path you're in? You use the 3 signals. Here they are. Signal 1. Watch the 10-year TIPS real yield on Fred. Where to look is the 10-year real interest rate series. What direction matters is up. If it rises for 2 to 3 sessions, gold weakness usually persists. Typical lag is same day to 2 days. Signal 2. Watch the broad dollar index on Fred, the DTWEXBGS series. What direction matters is a sustained bounce. If the dollar holds a rebound for a week, gold rallies usually struggle to restart. Typical lag is 1 to 3 sessions. Signal 3. Watch gold ETF flows and futures positioning. Where to look is daily gold ETF flow reports and the CFTC commitments of traders updates. What direction matters is outflows plus falling open interest. That combo suggests a real de-risk, not just a stop run. Typical lag is 2 days to 2 weeks. Those 3 signals are enough. Everything else is noise. Now, a quick nuance on signal 3, because people misread it. Price alone can lie. A sharp down day can be just stops. Stops clear and price bounces. Flows tell you if the market is changing hands. ETF outflows mean someone is reducing exposure, not just trading around a level. Open interest tells you who is still there. If open interest falls with price, it often means positions are being closed. That's a de-leveraged signature. If open interest rises while price falls, that can be new shorts entering. That can create a different setup, because shorts can be forced to cover later, so the flow plus open interest mix matters. It turns a headline into a mechanism, and it connects to the funding story. In a true liquidity squeeze, you often see selling across winners, not just weak assets. Gold can be a winner that gets sold, because it is a source of cash. That sounds abstract, so make it concrete. Imagine a fund that owns equities, owns credit, and owns gold as a hedge. Equities drop, credit spreads widen, the fund's risk limits tighten, the broker raises margin, the fund needs cash today, the fund sells gold. Not because gold is wrong, because gold is liquid. That is why a gold crash can coexist with scary headlines on the same day. Now look at the inflation channel. Gold often gets lumped into inflation hedge. That's not always accurate week to week. Inflation hedging is usually a bundle. It includes energy. It includes break-evens. It includes commodities more broadly. Gold is also a real yield trade. If the market believes inflation is sticky and policy will stay tight, real yields can rise. Gold can fall even with inflation fear. That's why the real yield receipt is so powerful. It separates inflation fear from policy tightness. And it ties into households. When real yields rise, borrowing costs stay high longer. Mortgages stay restrictive. Auto loans stay restrictive. Business credit stays expensive. So even if you never buy gold, this matters. Now the global angle. Gold is priced in dollars, but it's owned globally, so FX matters. If the dollar strengthens, foreign demand can slow at the margin. If the dollar weakens, gold often gets an extra tailwind. That's why the DTWEX BGS print is clean. It's not a guess, it's an observable index, and one more subtlety. Record highs often attract fast money, momentum flows. Short covering. Option-related hedging. When price accelerates, options dealers may hedge dynamically. That can push the move further. Then, when the move reverses, the hedging can reverse too. That can create a fast downdraft. So, you can get a day that feels like the floor is gone. But it can be microstructure, not macro. That's also why timing matters. Late month and around large expiries, flows can distort the picture. You respect the move, but you verify the driver. Now, what about other safe assets? This is where the story gets interesting. When gold falls on a fear day, you ask what did not act safe. Sometimes it is gold. Sometimes it is the yen. Sometimes it is long bonds. That tells you which part of the system the market is stressed about. If long bonds sell off with gold, the market is worried about inflation and term premium. If long bonds rally while gold falls, the market may be raising cash, but still buying duration. Those are very different worlds, and you can feel the spillover in equities. Gold miners can move more than gold. They carry operating leverage and equity beta. So, a gold reversal can hit miners hard, even if spot gold stabilizes later. That can ripple into broader risk sentiment, because miners often trade like high beta cyclicals. Again, no advice here, just mechanism. You are watching a stress test. Gold did an extreme move, then did an extreme reversal. Those are the days that reveal the wiring. Now let's apply the signals to the story. Because the viewer promise is practical. If signal 1 is rising and signal 2 is rising, this is a rates plus dollar squeeze. That usually keeps gold capped. In that world, the next break risk is not a gold collapse. It's a broader tightening in conditions. You'd watch equities for multiple compression. You'd watch credit spreads for slow widening. You'd watch housing and consumer rates over weeks. If signal 1 is flat and signal 2 is flat, but signal 3 shows heavy outflows, then liquidity is the culprit. In that world, the next break risk is more air pockets. You can get sudden drops in crowded trades, you can get spikes in vol, you can get stress in credit, and you can get weird mismatches, like gold down, but fear still high. If signal 1 is falling and signal 2 is falling, then the reversal may have been a flush. The macro backdrop is still supportive for gold, and the record high can get retested. That does not mean go buy gold. It means the narrative is not broken. It means the driver is still in place. Now we tie this back to rates, FX, and credit. Because risk and recap is cross-market. Gold is a bridge asset. It sits between inflation and fear. So its behavior often tells you which fear the market cares about. If the market fears inflation, gold can rise with oil and break-evens. If the market fears recession, gold can rise with lower yields and a weaker dollar. If the market fears liquidity, gold can rise first and then get sold. That last one is the trap. It makes people think the fear is over. Sometimes it's just the margin call phase. So, what is the catalyst window? What could change this in the next week? The first catalyst is macro data that moves real yields. Inflation prints can do it, jobs data can do it. Any surprise that shifts cuts timing can do it. The second catalyst is policy communication. If Fed speakers reinforce a path, the dollar and real yields can move quickly. If they soften guidance, the pressure eases. The third catalyst is market micro. Month-end rebalancing can create flows. Option expiries can create hedging demand. Those can amplify moves without changing fundamentals. So, you do not need a prediction, you need a checklist. Here's how you use the checklist. You look at signal 1 and signal 2 first. Those tell you if the macro wind shifted. Then you look at signal 3. That tells you if the unwind is still active, or if it is mostly done. Now, let's talk about why this went viral. Because virality comes from clarity. Most coverage says, gold fell because profits. That's not wrong, it's just incomplete. Profit taking is a label, mechanism is the explanation. A real mechanism has a chain you can test. Rates moved, so gold repriced. Dollar moved, so gold repriced. Margin rose, so gold was sold. That is why receipt moments matter. You show the line, you show the chart, then you connect it to the chain. The first receipt was the Reuters line. Record high, then one of the biggest drops. That tells you the move was two-sided. The second receipt is the Fred check, real yields in the broad dollar index. That tells you whether the unwind was macro or whether it was funding. When you show those two receipts on screen, the viewer feels in control. They can verify it. Now we bring it back to what could break next, because that's the brand. If this was a macro repricing, the next break tends to be gradual, a series of tighter conditions, a bit more strain in rate-sensitive sectors. If this was liquidity, the next break tends to be sudden, a gap, a forced unwind, a surprise blowout in spreads. The key difference is timing. Macro works in days to months. Liquidity can work in hours to days. So here is the risk framing, without doom and without certainty. This reversal can be a one-day stop run. It can also be the first crack in a crowded protection trade. You will know which it is by whether real yields in the dollar follow through, and whether flows keep leaving. That's it. No drama needed. Now, let's recap cleanly. Gold hit a record and then reversed hard. That kind of move often signals constraints. Either real yields tightened or the dollar snapped back, or liquidity demands forced selling. Your three signals make it testable. Watch the 10-year TIPS real yield on Fred. Watch the broad dollar index DTWEXBGS on Fred. Watch gold ETF flows and futures positioning. If real yields and the dollar rise together, gold weakness can persist for days. If they stay flat but outflows accelerate, that's a liquidity unwind story. If both soften and flows stabilize, the record high narrative can return. That's the risk, and that's the recap. If you want the clean signal check, look at those three markers this week. I'll see you in the next one.